6:44 right now, whether you're buying groceries or filling up gas, we're all feeling the impact of inflation. To help fight inflation, the Fed raised interest rates twice in less than 3 months. But is this going to work? A lot of people are wondering. And what should we be doing in the meantime? Orange County-based financial professional Brian Levy from BML Wealth Management is here to share what the latest hike means for you and your family. Brian, good morning. Great to see you.
Morning, Adrian. Good to see you as well.
All right, so we know the cost of everything is way up right now. Families are struggling. So talk to us a little bit about what the Fed did. And do you think down the line this will eventually help families, and how?
Yeah, absolutely. So as you mentioned, the Fed raised rates 50 basis points, which may not seem like a lot, 0.5%, but it's the largest increase in 2 decades. So that's really the borrowing rate that banks can lend to each other overnight. And ultimately, the Fed has, I know this sounds scary, 5 more meetings this year. They have 8 total in a given year. They have 5 more meetings, and we think those rates are going to continue to climb.
And so what kind of impact will these rate increases have on borrowing costs?
Yeah, so borrowing costs are going to go up. And that's really the reason, Adrian, the Fed's doing it, right? We have inflation that's well above the 2% target that the Fed wants. But that was caused by a supply issue, which started with COVID. And then on top of that, we add the war to that. And ultimately, that's what's causing the rising of prices. So they're trying to slow down the economy, increase borrowing costs, which just makes it more expensive to start a business, more expensive to pay down your credit cards, and more expensive, obviously, to take out a mortgage.
It's still just interesting because you're trying to slow things down to help things out in the long run. It's kind of counterintuitive here. But with the rate hikes, how they affect savings, Brian?
So saving, it's funny because we're basically, a lot of people are fearful. Well, rates are going so high. Oh, my gosh, what's going to happen? If you really think about it, we're just getting back to the norm, right? We're getting back to pre-pandemic levels. We got so accustomed, I don't know about you, Adrian, we got so accustomed to 0% interest rates, right? But that killed savers. Savers were penalized the last several years, where investors benefited, right? Because it really inflated the stock market. So savings account rates are going to go up, even though the average is only about 0.06% rate a year. I see some out there for 1% right now on a money market account nationally. So you can check out those high yield online savings accounts. But ultimately, those rates are going up, and that should help out a little bit when it comes to the inflation.
And what will the rate hikes do to mortgage interest rates? Because we were talking about, it's like even though the rates are getting higher, they're still pretty low, all things considered, right?
Yeah, absolutely. I looked last night, the 30-year mortgage right now, the average is over 5.5%, where just a couple years ago, I know when I was looking to purchase a new home, it was like 2%, right? So it's doubled the rate in the last couple years. But if you look back since like the 70s, the average 30-year mortgage rate is closer to 8%. Right. So again, I think we got accustomed to this abnormal environment, and we're just getting back to that scenario where, hey, it's sustainable long term, but it's certainly going to have an impact on home prices because it's going to be more costly to borrow that money and pay down that mortgage.
And it's not just people who are feeling the impact of this inflation, Brian, but big companies like Walmart and Target, too. They've been struggling. Wall Street is down again this morning, opened lower. How worried should we be about our 401ks? I know that we're not supposed to check it daily, but we're taking a look at the Dow right now, Brian, and it's down again more than 400 points as we speak. Yeah,
absolutely, Adrian. I mean, right now is the time that you have to fall back on a plan. There's no question, you're right. The stock market pretty much is down almost 20% so far this year, but we can't look at that in a vacuum, right? If you look at 1 year ago today, it's only down about 5%. And if you look over the past, 5 years or so, the market's up 65%. So you got to kind of take it in perspective, right? I don't want to say we're playing with the house's money because obviously it's our money. But at the end of the day, if you have a plan, right now is not the time to be selling off unless you actually need the money to live. It's a time to actually look and say, hey, am I in the right place? Am I taking too much risk? what we do for our clients as retirement planners is determine, hey, what is your risk budget, and build a plan around there. And a lot of things have to do with how much time you have, right? As we get closer to retirement, we have less time than you do when you're younger. So you just got to reassess it and make sure you're not making an emotional decision, because time in the market is more important than timing the market.
Yeah, the ebbs and flows, the roller coaster ride. Just feel for the folks who are retiring right now, Brian. Brian Levy from BML Wealth Management. Thank you again for joining us, for all your help and information. We appreciate it.
Thanks, Adrian. Have a great day.
All right, you too. And you can get more information at bmlwealth.net.
Great perspective there.
Yeah.